Hey everyone, in today's video we're going to go over credit versus debit spreads and my rule of thumb on trading these spreads. When's the correct time? What stock should you be looking at? What type of implied vol? What should the VIX be? We'll cover all those subjects in today's video. So grab your scratch offs. We're not going to be doing any short dated lotto tickets in the options. That might be the next video, wink wink. But let's go ahead, take a look, share the screen with you, and make sure you like, subscribe, leave a comment on the video, share it with a friend, and let me know what questions you have in the comments for our next video in long versus short dated options. Let's get to it. Hey everyone, let's get into credit versus debit spreads and just a quick rule of thumb. Usually, or should I say back in the day, we would only sell premium or do a credit spread when the VIX was over 20. Obviously, nowadays, the VIX is very under 20. We hit a 20 spot back in April, but really since 2023, we haven't got much VIX over 20, so it's been more of a option buying opportunity or a debit spread. But I'm gonna show you both, so let's get into it. Let's first look at, let's say we are looking at the Russell 2000, the IWM. Now, since the VIX is so low and volatility is so low, I want to look at a debit spread. Some stocks will always have high implied volatility, hence why the expensive options, like maybe a super micro computer, it moved $100 from high to low today, you can see volatility high. A name like NVIDIA is usually going to have high implied volatility, right? A name like AMD, usually high implied volatility. Think of your crazy stocks with big moves. You really want to spread those names out. Same with IWM. So let's look at it. You can see I drew a little box here, a little gray box, where I think the IWM has been in a range for quite some time. I'm looking at this as support. My upside bullish price target would be somewhere anywhere between, let's say, 202 to, let's just say 208. So this upside box here, I think the Russell can get anywhere up there. Since we have a cheap options, a low VIX, volatility ain't too high, let's look at, first of all, a debit spread. So let's go to the IWM. Let's go ahead and look maybe a month out, so July 19th expiration. And if I want to do a debit spread, I can look at something like maybe the 202 calls. They're about $3.70 right now, so kind of pricey. Usually I like buying options under $1. So what I can do to help finance these calls is make it into a call spread. That would be a bull call spread. Now, since I said it could go to 208, let's just go ahead and sell these calls, and they're about $1.55. So I turned that trade into what we call bull call spread. I bought the 202 calls, and I'm going to look to sell the 208 calls. That would be the 202, 208 bull call spread. Maybe, let's say it goes down a little bit, I could get filled at $2. So let's look at the risk versus the reward, because I always want to look what is my max risk per trade. Well, just like a normal call, my max risk would be the price I paid for the options. And since I paid $2, my max loss, if the IWM went under 202, let's say it went to 190, it would be $200. $2 multiplied by 100, that's $2 or $200 per contract. My max upside target would be the 208 minus 202, that is $6. How much did I pay for the debit? $2. So that would be $4 or $400 would be my upside target. Now that $400 is capped, just like with any spread. So if the IWM went above 208, I would be capped at $400 as max profit. If we went to, let's say, 220, I'm capped at $400. That's the bad part about any spread. But with this spread, what do I need? I need for it to move. My break even would be 202 plus the net debit I paid. That'd be 204, as you can see right there. But with this, I do need the IWM to move over 204. So remember, the 202 calls I bought, I paid a net debit for the 202, 208 call spread of $2. So I do need 204 or above to start making money, moolah, okay? But with the credit spread, let's look how that is calculated. Let's go ahead and do the IWM credit spread. Now with the credit spread, this would be considered not too directional. Some people even say this is a income strategy. Well, I hate using that word income, but it's a marketing ploy, just being honest with you. So if we look at the IWM, now I'm not gonna sell the 208 or 202, just like with the calls. What I can do is, since I think the IWM is, well, it's relatively neutral, and I think it go down maybe to 196 as support, I could do something in the IWM, what we call bull put credit spread. Now I can do this in two ways. I can do this, maybe I sell the 200 puts for about 360, and I buy the 199 puts, and I'm getting about a 40-cent credit. So that would be, I'm risking 60 bucks, the price, the width of the spread, minus my credit, so that'd be 60 bucks, to make $40 credit. And all I need on that trade is for the IWM to stay above basically 200. That's it. Really, it's 200. Really, it's 199.60 is my break even. So a pretty smooth trade, right? All I need is the IWM to stay above 200. I make 40 bucks. If it goes below 199, I lose 60 bucks. Not bad. But let's say I'm nervous. I'm scared. Money out there. And I think the IWM maybe sells off down to 196. What I can do to give myself a cushion, and I can do about a $4 cushion, is I could sell, let's say, the 196 put and buy the 195 put. I'm still doing a bull put credit spread, but I have so much leeway. So let's go ahead and sell the 196 puts. I'm getting less, only about 217 as you can see. I'm gonna buy the 195 puts. So instead of getting 40 cents, I'm getting about 25 cents. But if we analyze the trade, here's what's cool. As long as the IWM is above 196, I make 25 bucks. If it's below 195, I lose 75 bucks. But unlike a call spread, where I needed it to go above 204, I only need it to stay above 196 here. So yeah, my reward is not as great, but my risk as well really goes down because I can be wrong on direction. So that's what's really cool. If you want to get super nerdy about it, let's say, and this is what we call limited bullish risk reversal. I know. Weird, I know. Let's say I'm scared a little bit. I want myself a cushion, so that 196 area. But I think maybe we have Jay Powell cutting jobs or cutting interest rates, and sparks fly and the greatest stock market appears, and we go up to 208 over the next few days in the IWM. What I can do is, instead of just buy the 208 call, which is $1.56, I can do this. I can buy the 207 call. It will cost me about $1.80. I can sell the 208 call. So I'm gonna get about $1.55 for that. And look at here, my net debit is almost zero. So let's go ahead and see what that trade looks like, shall we? So this would be what we call a limited bullish risk reversal. So I'm selling the 196 put, buying the 195 put, so that bull put credit spread. I'm using that 40 cents, or not 40 cents, pardon me, 25 cents for that trade of a credit to help finance the 207, 208 bull call spread. So you can see here, that would cost me about 25 cents. So my net debit is zero. All I need for the IWM is to basically stay above 196.25 all the way to about 206.75, and I basically break even on my money. If it goes below 195, yeah, I start to lose money. If it goes above that 208 though, I make 100 bucks. It's about 4x my money. So you can help use a credit spread, a bull put credit spread, to help finance a debit spread and get directional on your trade.